has been trolling you.
वही लग रहा है मुझे।
पता नहीं, मुझे लगता है people have been feeding false news maybe.
अभी ये पीयूष ने एस क्लास खरीदी है, आई एम टोल्ड।
Hello, Piyush.
Hi Piyush.
मेरे को खरीदने की जरूरत नहीं पड़ती अभी तक।
हाँ, मैंने देखा है, तुम कानपुर गए थे, वहां भी तुम्हारे लिए लिफ्ट की गई थी। हाँ,
I mean, today we are expecting a big presence. The big thing that unites us all is money.
or divides us. Huh? It can also divide you.
Yeah, Prashant, you are right. You have better insights, I guess.
Babua, don't undermine Prashant's talk. We are here because of his talk, not because of money.
Yeah, sure. No, it's going to be a very fascinating talk. Actually, you shared the presentation with me. It's just amazing. So, Prashant, I mean, before we begin, बहुत सारे लोग join करेंगे, hopefully. I just wanted to let you know, I mean, so talk is talk, but I mean, apart from that, we want to learn more about you before you join IIT and after your journey. Because IIT में तो हमें पता ही है तुमने क्या किया, so उसके पहले और उसके बाद का भी थोड़ा स्टोरी बता देना. How did you end up in this field, and उसके पहले मतलब when you were growing up, a little bit about that.
No, sure, it's a very boring journey, but I am happy to share whatever little.
अरे बिल्कुल, I mean, most of us, I mean, we know each other only from IIT days. We don't know what our backgrounds are. Last time Nagendra's journey was so fascinating. It's just good to know where people are coming from, कैसे backgrounds से आए हम लोग सब मिले, 4 साल रहे वहाँ पर, and then we lost touch completely, most of us. अब जब we are at the prime of our careers, Piyush, you also have to talk, man. You एक दिन prepare करके रखो. So we will learn more about each other. That's the goal.
Hi Naveen, उठ गए तुम?
उठ गए?
Why in black and white, भाई?
नवीन को ब्लैक एंड व्हाइट बहुत पसंद है.
अभी
यार ब्लैक एंड व्हाइट एरा के लोग हैं यार हम लोग.
वो क्लासिक रहना चाहते हैं.
एकदम क्लासिक. संदीप है कहाँ? दिखाई नहीं दे रहा.
अरे ढूंढोगे तो सब मिल जाएंगे
यार.
So Rahul, I don't understand कि ये जो फोटो जो तुमने भेजे उसमें फोटो ले कौन रहा था? Where did you get these photos?
सैफी को ढूंढो, वही कहाँ पे है सैफी?
Oh, Saifi is there.
देख रहा है.
He calls himself Shetty now actually.
बॉय अंडे की तरह लग रहा है.
So who actually took the pictures? जो photos paste कर रहे हो?
यार पता नहीं यार. Don't remember. I think it was Misra ji's camera.
लेकिन मिश्रा जी खुद ही थे. तो कैमरा तो मिश्रा जी का होगा.
Gave it to someone. राहुल, वो याद है कौन फोटो किसने ली थी?
अरे वो एक सीनियर था भाई, वो हमारे ई-बॉट में आधे सीनियर्स भी रहते थे ना, इफ यू रिमेम्बर.
संदीप बोस वगैरह.
तो मुझे याद नहीं, कोई एक सीनियर.
It's amazing.
अबे सैफी क्या हुआ यार? तू एकदम बॉइल्ड अंडे की तरह लगा है एकदम.
The hair is growing here now. Not growing there.
वक्त ने क्या किया हंसी सितम.
सही बता रहा हूँ यार.
सब लोगों का वही हाल है यार.
Yeah, for first time I met Saifi after coming here. वापस गया तो Saifi घर ले गए अपने ने कहा कि चलो तुम्हें ऑमलेट बना के खिलाता. Saifi को याद नहीं होगा. So मैंने कहा अरे वाह, मैं इसका खाना खाया बहुत दिन हो गए, चलो. So Saifi ने अंडे लिए और उसमें से सारा येलो निकाल दिया. मुझे तो आधा पता नहीं था मैं. तो then that was my first education in cholesterol and this and that. सभी ने कहा येलो वाला नहीं खाना चाहिए. सभी भी कहीं से सीख के आए होंगे.
बाबा ये कहाँ है? Where was this? Which city?
अरे तुम्हारे घर में तुमने बना के खिलाया.
Wow. नहीं अब तो अंडा मैं पूरा जर्दी के साथ खाता हूँ.
Awesome. Okay, as soon as we hit 20, we will start, and then other people's loss. This is going to be.
हंसते मुस्कुराते हो कि नहीं आजकल? एकदम सीरियस हो गया यार. लगता है पूरा इंडियन फाइनेंशियल सिस्टम का बोझ तुम्हारे कंधों पर आ गया है.
So Sandeep, can you check once? I mean, because it looks like some people are trying to join and are not able to.
Asad said that he's joined on YouTube. सिर्फ सुन और देख सकते हैं.
अच्छा. But the count won't increase here. Is that the deal?
Yeah, it will not increase here. I can count there and let you know. Just
because I think quite a few people have joined on the other one.
Okay. And that was the attendees link, so they must have joined it. Make secondary.
Yeah, good thing ये platform भी अपना ही है. So
I think we start करते हैं.
Yeah. We should start. So Prashant.
Sure.
Yeah. Before we get in the talk, I mean, talk a little bit about your background and also, I mean, how you got into this field after you left IIT. Oh. Because you left as mechanical engineer, right? As far as I remember.
No, that's right, Tushar.
हाँ ठीक है.
So बचपन से लेके शुरू करो एकदम.
Sure. I'll just take a. So hi everyone, and extremely nice to connect with all of you after a very long time. And thanks Vishwa for organizing this and for prodding me into this. So my father was a state bureaucrat, and we were transferred all over. And those days, you were told that boys could either take biology or maths as a career option. So biology was not an option because I could not handle dissections and all. So maths actually was my weakness, but I found some good teachers, and there was no other way out. So I guess I made it to IIT, and then after IIT, I did not want to go abroad, being the only son, and I also did not want to work immediately. And my father said, write civil services. So I also joined IIM Bangalore meanwhile, and there I actually qualified for civil services, income tax, but didn't join at the last moment because of the environment was very challenging in government services. And then at IIM, I had the unique, funny notion that one should not work for multinational companies because they are not good for India. So I ended up joining State Bank of India, SBI CAPS, and that's I was the last one to join in my batch actually, because I was debating whether to join civil services or not. So when I reached office first day, the GM told me, "Kisan, I am sorry, all the good postings are gone, and you can do only equity research." So what this explains is that equities was not a preferred career option way back then. The project appraisal, merchant banking, marketing, they were preferred. So that's how I moved into equities. So it was entirely by default. And of course, since then I moved over to a private sector mutual fund, and I was part of the startup team way back in '94 when we, I think, set up India's second private mutual fund, and that fund was acquired by Zurich Financial Services. They used to own Kemper Corporation way back then in US, and they ultimately sold the business to HDFC in 2003, and I moved along with the business. And so I haven't really changed a job now 27 years.
Wow.
I have been running the same fund. I mean, I have two roles as a chief investment officer of HDFC Mutual Fund, and we manage close to 4 lakh crores. I think it's some 60 odd billion US. Half of it is in equities, half of it is in fixed income. And I also double up as a portfolio manager. So I've been running three schemes uh, for between, I would say, 22 to 27 years. And I think now I am in India at least the longest serving manager. So that's what my journey has been.
Wow. Amazing. That deserves some clapping, I think. Yeah, that's amazing.
So before moving on, I think this is the highest IQ audience that I am speaking with, and it makes me obviously very nervous. But what
I
gives
think
me
I think you are underestimating some of us.
Or overestimating.
underestimating,
Overestimating.
underestimating. But what gives me confidence to speak is because what Warren Buffett has said is that in equities, in investing, emotional quotient EQ is more important than intellectual quotient IQ, and I have experienced that. And in fact, he says that if you have high IQ, you are wasting your career, you are wasting your intelligence in investing. It is so simple, and I think it is right. It is extremely commonsensical, but it does require lots and lots of EQ, and that is what I am happy to share with you some insights that I have gained along on in this journey. So I think equities are a very simple asset class, but what I've realized, even those who have done extremely well in academics and in the various professions, the right understanding of equities is somehow missing, and because of I think for a variety of reasons. So the way I look at equities is something very simple. Over short periods, any equity is like tossing a coin. It could be heads, it could be tails. So stocks could go up, stocks could go down. And a lot of bright engineers, mathematicians, PhDs are devoting their whole careers to forecasting movements of the market. I think to some extent it is possible you can various measures of momentum if you start tracking and first, second, third derivative, whatever. I don't know what they do, but I do feel that it is extremely hard to do that reliably, and markets are prone to changes overnight because they are influenced by so many factors, and sentiment is extremely fickle thing. Uh, and see, think of it this way: every trade that is taking place reflects two contrary opinions. Same company, same time, same price. Unless two individuals think exactly opposite, the trade will not take place. And I think that in itself is proof that only one of the two views can be right. So I think if you try to time the markets, at least in my experience, even professional investors, they get it wrong many times because even professional investors are, they have the same emotions of fear, greed, and hope. And unfortunately, for most, fear dominates in down markets. Markets are down when the environment is very challenging, like it was last year. And falling prices unnerve most people, difficult headlines unnerve most people. And therefore, most of the investments, a vast majority of investments in equities takes place in good times. And good times means things are good, business is good, profits are good, momentum is good, but so are the valuations. So you are unlikely to buy anything cheap in good times. and you are unlikely or less likely to buy anything expensive in bad times. So that's why I have experienced time and again that even though the perceived risk is very high, when times are challenging, the real risk is actually quite low, and vice versa. So the best investments are invariably made in the worst of times, and vice versa. Of course, this holds true only over very long periods. In the short run, you buy in an expensive market. For some time, you may still make some money, but I don't think that will lead to the best possible outcomes of equities. Now, coming to the long term, I think equities are a fairly simple asset class. Over long periods, the returns or the wealth creation by any company's share is quite closely linked to the growth of the underlying business. Of course, PE multiples valuations can change a bit, but over really long periods, the impact of change in multiples is maybe 10, 20, 30%. And a large portion of the returns, in most cases, are generated by the underlying growth of the businesses. I think the cardinal principle of investing in equities is that you must maintain diversified portfolios, and therefore, uh, I will not go into any stocks. I don't think this is the right forum, or one can even do justice. And even after 30 years, we are still making mistakes. But I will share with you some broad thoughts about Indian and Indian markets, the way I see them, and why, uh, despite fairly challenging last year, equity markets have done quite well. So let me share with you a, presentation now. Uh, yeah,
Yeah, we can see it.
yeah. So see, uh, this is a journey of the India's economy over last 40 years. And as you know, any business or any economy grows in two ways. One is the volume growth uh, of the business or the economy. If you sell 100 cars and next year you sell 110 cars, so 10% is the volume growth, and then there is a price element of price growth, which for a economy becomes the inflation measure. So what is remarkable about this slide is in last 40 years, you will see every 10 years, these are decadal growth rates, the real growth has been pretty stable, around 6-7% a year, and inflation, which used to be 9%, 10% in 80s and 90s, last 20 years it is around 6% a year. As Indian economy has opened up, as foreign direct investment in India has increased, as software services has grown to a scale where India's current account deficit is more manageable now, and that's why the currency depreciation has been more moderate, leading to lower inflation. So I think, uh, but the interesting thing is the rupee GDP growth, real plus inflation. If you add the two up, it is around 13 to 15% over last 40 years. And this period has seen some very difficult times, very difficult events, and some of these are listed. But the good news is that while these events occupy a lot of headlines and our mind share, they a real long-term impact on the economy of most of these events is extremely low, as is obvious from the data. So India represents a fairly secularly growing economy, and I feel that there are certain factors which should actually drive the real growth even higher going forward. So, what are some of these factors that is driven this growth in spite of these very challenging events now and then? I think our population grows 1.5 to 2% a year. Family sizes are reducing, joint families are breaking up, So the number of families is increasing faster than the population growth. And when you think, you will realize that the family is a unit of consumption for many things, right from a home, car, all the durables, etc. So the more the number of families, the more is the growth in demand. So I think virtually half the growth, or 40% of the real growth in India over last 40 years, one can explain just by the increasing number of families, 2.5, 3% a year. People are marrying later, staying separately. Some have two homes, and some don't have children. So the number of members per family is falling quite rapidly. Of course, we have a lot of skilled young English speaking, and wages are low, which is what is the reason for the IT industry success. I think IT industry has been a key driver of growth in India, because but for the dollars which it earns, the purchasing power that India has would be much less. Apart from oil, India has almost all the natural resources, and we don't realize it, but fertile land, water, etc. And now solar energy. I think as solar power comes in, as electric vehicles come in, I think this is a resource that will be priceless, and India gets abundant sunshine 365 days a year. Services, we have a clear leadership position, and there is no competition round the corner. I think we also have a very low penetration of consumer durables in India, and that is what drive gives us huge headroom for growth. Some of you may be surprised to know that only 1 in 10 families in India has a car, and 1 in 20 families in India has access to air conditioning. So the headroom for growth is pretty significant. We have significant needs of infrastructure, and all of us have experienced that. Power is now becoming more good quality power. We have is intra-city roads are good, intercity roads are improving, but municipal infrastructure, I think, whole lot of areas we still need to invest fairly large amounts, train, railway modernization, etc. I think two things which are worth mentioning here. While why the environment has improved, I will mention it briefly here and take it in some detail later on. Two things have changed in COVID. One is, world over we have low interest rates. Governments, central banks, excess liquidity, low interest rates suits a country like India, because India needs large amounts of long-term, low-cost capital to build its infrastructure and to build its manufacturing, and which is what we are seeing, that the FDI flows, the FII flows have been extremely healthy, and you can see a lot of money flowing into REITs, InvITs, various infra projects, etc., which is good for us. The second, I think, is China has lost or is no more as competitive in cost as it used to be. Manufacturing was slowly shifting out of China. I think the disrupted supply chain, along with the over dependence on Chinese supply chain, has created a strong sense of urgency in large companies in the world to adopt the China plus one strategy. So I think the shift, what would have taken probably 5, 10, 15 years, will now happen much faster. And I think India is extremely well placed. Our ease of doing business rankings have improved from 160 to, I think, no, 140 to 60. So we score ahead of Vietnam now, slightly behind China still. But the government is taking steps like the PLI scheme, discouraging imports through policy steps, etc. So I think, given the very large local market that we have, if we use that as a lever to encourage domestic manufacturing, I think the environment is very conducive to make a success out of it. And these are two things which I think have created a better economic environment for future growth post COVID than it was pre COVID. Now
So
let's
Prashant,
yeah.
Prashant, you mentioned for a second time there. What was the first time? Oh yeah.
No, I said two factors.
No, I mean it says if manufacturing opportunity for India for a second time.
We missed it about 20-30 years back. I mean, if you go back 30-40 years, 40 years back, India's per capita income was same as China. And we did not capitalize on it. I mean, the chemical industry in India was as large as it was in China. But for a variety of reasons, we could not capitalize. But now, Chinese per capita income is 5 times of India. So I think the environment, because your biggest competitor is now losing competitiveness. So I think we have a second shot at this.
Wow. Okay, cool.
Now this is a, so I think this is a very, this I call the Bible of investing, Gita of investing or whatever. This is a very simple slide and I have been presenting this for now almost 27-28 years. And I think being engineers, all of us will, it should be very easy for all of us to understand. See, this basically gives the value of the Sensex, which is nothing but a average of all the stock prices in the country, right from 79. And the next 4 columns give you the rolling 1, 5, 10 and 15 year annualized or CAGR compound returns. And I'll just take maybe an example or two. So if you look at March 89, value was 714. March 90, it was 781. So that year returns was 9%, which is written under the 1 year column in the March 90 row. The next column gives you the 5 year returns. If you bought the Sensex in March 84, let's say 245, in March 89 it was 714. So money became 3 times in 5 years. That is equal to 24% CAGR returns over that period. Now, if you glance through these numbers, you will see few trends. The 1 year returns are extremely volatile. There is no trend, no pattern, no algorithm will help you forecast the next year returns even closely. And this is what I meant when I said in the short term, equities is like tossing of a coin. Or you could say it's like the outcome of an election or whatever. And you can also see that over the last 40 odd years, 42 years now, Sensex has completed. In 14 out of 42 years, there were losses. And losses are less because India is a growing economy. So generally the value of the business goes up and therefore markets have an upward bias. But still in 1 out of 3 years, there was a loss. And you can see the returns are extremely volatile. And the returns are extremely volatile. And this highlights the high risk that equities carry over short periods of time, hard to forecast. And as you go to the right, as your holding period becomes longer, you will see that the volatility, the fluctuation in returns reduces. The chances of loss also reduce. And as you go towards the 15-year column, you will see that barring 2-3 very years with very high or very low returns, there are reasons for that, but maybe I can come back to that or I will skip that. But what is interesting is that if you look at the most of the values in 15-year column, the returns are around 11, 12 to 16, 17%. And the reason for that, why returns are converging towards 13, 14% is because India's nominal GDP, rupee GDP has grown by 12 to 16% over last 40 years. And what is the economy? It is nothing but a sum total of all the businesses in the country. It is fair to assume, therefore, that what the Sensex represents the economy quite closely. And so I think you can see how equities create wealth over long periods of time, and the risk actually is quite low as your holding period increases. I think few more. Yeah.
Quick question. Are these returns inflation adjusted or in current rupee terms?
No, these returns are in current rupee terms because the economy is also in current rupee terms.
Okay.
So the way to take that a step further is see, equities are an instrument that give you real returns equal to the real growth of the business. So as you saw on the first slide, the real growth has been 6-7% a year, and inflation was likewise. So you can say roughly, let's say 14% return, 50% is inflation, 50% is real. But compare this with bonds. Bonds give you zero real returns, sometimes even negative. So bond, and I will share with you the next slide how different asset classes have performed. So simple answer to your question could also be equities is an asset that is increasing your purchasing power in the Indian environment by around 6-7% per year. Now there are two more things here. One, in apart from these returns, you are also getting dividends, which is another 2% a year, which is not captured here. So you could increase these returns by 2% a year. That will make a very big difference over long periods. As we know, 1-2% extra return over long periods makes a very large difference to wealth. I think the most important takeaway on this slide is 100 rupees of Sensex or 100 of Sensex has become 50,000 over 40 years. That's 500 times. And I mean, it was not difficult for anyone to achieve that. There is no security selection involved here. There is no timing the market, absolutely nothing. Just you have grown in line with the Indian economy, and that's the power of compounding. And I think this is the most basic, but and that's why I say equities are a simple asset class, but they are not easy because emotionally we are geared to not think 40 years, but emotionally we are thinking next week, next month, next year. And we are influenced by the environment, the headlines, the talk around us. So I have seen in this journey over multiple occasions, that huge amount of money, huge amount of retail participation in great markets. And I will let me share with you one or two interesting insights here. So if you see, the Sensex was 400 in March 88, and it was 4,000 in March 92. So in 4 years, the Sensex became 10 times. And believe me, in 92, it was like a raging bull market. And I mean, anyone and everyone you could come across was buying into stocks. So people were buying happily at 10 times the stock prices, and they were not participating in 88 because people simply extrapolate the recent past into the future. The headlines, the whole environment becomes such that everyone is making money, I should also participate, and confidence simply goes up, leverage goes up, valuations go up, and even new supply of stock goes up. So a huge amount of IPO activity was also there. Exactly 10 years later, in 2002, you can see the Sensex was down after 10 years by 30%. What was 4,200 in 92 was 33,000 or 3,400 in 2002 and 3. And in 2002 and 3, when I used to travel and recommend funds to people, would criticize me. Stocks have done nothing for 10 years. Why should I invest? I am better off even in bank FDs. But that was the time, because stocks had not done well, but the underlying economy kept on growing. So stocks had become really cheap. So, but that time there was no interest in stocks, and that year was the year in which mutual funds collected the lowest ever money in their history. One full year, I think we got some 140 crores, the entire industry. So I think this is the main challenge in equities, that people are extrapolating their past experience into the future. The reality is opposite. If past returns are much higher than nominal GDP growth rate, it suggests equities are expensive. And when past returns are very low compared to the nominal GDP growth rates, that means equities are cheap and you are getting good value. So I think if you simply keep track of the trailing 10-15 year returns, and when they are diverging from the GDP growth rates, if you do the opposite, I think equities will deliver even more than what the averages have delivered.
So, so Prashant, what is the situation today? Like, is it
So
like
today,
giving more returns?
if you go to the last row, March 21, and the index is pretty much there around 50,000, you will see the 10 and 15-year returns are around 10% a year. So, which is reasonably close to the nominal GDP growth rates. And that's why I feel the markets are not overvalued. They are somewhat fairly valued. Fair value means that your wealth should grow in line with the nominal GDP growth rate. So if I were to take a guess next 5-10 years, I think we could compound at 12-14% a year, because that is what is the nominal GDP growth rate. Yeah. So moving on, I think this is again a slide which is very simple, but I think so. In this, we are looking at three asset categories: the Sensex for equities, fixed deposits. We have taken SBI's fixed deposit rates, and gold. So if you put 100 rupees in each of these three in 79, you can see how the outcomes are very different in March 21. Equities, of course, is 50,500 times. In FDs, assuming zero tax, money 100 has become 2,800, and in gold it is 6,000. So some people once in a while they say, look, equities are compounding 3, 4, 5, 6% higher. Is it worth the risk? For 1 year, maybe not. 2 years, maybe not. But you can see over a 40-year period, it makes a difference of anywhere between 10 to 20 times to your wealth. So I feel the earlier people start investing in equities, the more time they will have for compounding. So I think, and this slide also tells us very clearly that the key to investing is not security selection. People spend most of the time buying stocks, and they devote very less time to asset allocation. This was, I discussed with you, Sensex, nothing else. No security selection, absolutely nothing. So if you just allocate your money, because the nature of the asset classes is so different. So equities, long-term compounding is much higher. So I think the key is asset allocation. And my simple thought there is, whatever portion of your money you don't need for 5-10 years, where you can tolerate volatility emotionally and financially, that is what you should invest in equities. So moving on, I think these are some thoughts on equities, and I think this may be quite basic, but as I said, equities are not complex stuff at all. I think some quotes are very interesting. Stock market is a device to transfer money from the impatient to the patient. And so you can see on the table at the top that as your holding period increases, the chances of higher returns keep on improving, and the chances of loss reduce. So in equities, unlike bonds, risk reduces with time. Of course, I am speaking only about diversified portfolios. So that is a cardinal principle in equities, that we must remain diversified across sectors, themes, whatever. And I think the second is what I was referring to, asset allocation. What I have realized, even that very smart people, intelligent people, experienced people are spending considerable time in either trying to time the markets or trying to select securities. And clearly the big difference, 80-90% of difference to wealth, is made by asset allocation and less by security selection, and also less by timing. Let me take you back just half a minute. I think I will share with you how timing is actually not very relevant. Let's say we were in the year, what? Let's say we were in March 94. Index was 3779, and in March 95 it was 3261. So index was down 15% that year. If you invested in 94, you were feeling quite terrible. You were down 15%. But today, if you look back after whatever 25 years, when index is at 50,000, it makes little difference whether you invested at 3,800 or 3,200. So movements of 10-15% would appear to be very large in the present. After 10 years, they will appear to be quite inconsequential. And what will make the difference to your wealth is what portion of your wealth was in which asset category. And this is why I think there is a popular saying in equities that time in the markets is more important than timing the markets. How much time you remain invested makes a much bigger difference to your wealth than timing error there. I think diversification I have already discussed. I will not go into this. And see, this is what I was saying. A lot of people with what Charlie Munger says, he is one of the smartest investors. A lot of people with high IQs are terrible investors because they've got terrible temperaments. So I think this is the key to equities, that you must, you can read the last line also. So this is Warren Buffett. I will tell you how to become rich. Close the doors, be fearful when others are greedy, and vice versa. So I think in the short term, this could lead to some gains in expensive times or some depreciation. But I have seen invariably, if you think few years also, this works out absolutely beautifully. And what you could do is, when the going is very tough, if you don't have the confidence to go in one day, you could spread out your investments over few weeks or months, and vice versa. And today I think there is reasonable evidence to suggest, uh, while the markets are still fairly valued, I think excesses are beginning to build in India, and the classic signs are all there. The number of demat accounts in the country has increased from 2 crores to 6 crores rapidly. Massive increase in direct retail participation world over, rapidly moving stock prices, and the IPO markets in India are hotting up. And you can see companies virtually every week raising $1 billion, $2 billion. So I think eventually, uh, I mean, there are signs that it could move up, but eventually it will create an excess. A bubble is formed, and eventually markets correct. So this is how the cycle goes on. I have experienced 3 cycles myself: 92, 2000, 2008. These were 3 massive peaks in the markets, and these excesses also tend to be more localized. So the after 92, the entire broad markets have never been significantly overvalued, but pockets were very expensive. Like 2000 was tech, 2008 was real estate and NBFCs and power. And now again, I think there are excesses building up in some sectors. uh, I think, let me now just share with you some very quick thoughts. I think the economic impact of second wave has been much less, because businesses, people have learned to operate out of homes, and barring contact intensive services like restaurants, eating out, retail, I think the economy is doing reasonably well. And you can see that in the Google Mobility Index, or you could see it in tax collections, unemployment rates, or even the power consumption. So power demand continues to grow, and India last week crossed 200,000 megawatts of peak power requirement. So let me now share with you, and this is again a slightly interesting chart, the top one. Last year was the first year in 40 years when Indian economy contracted. Indian economy grew even in the Lehman year. So the underlying growth drivers are so secular, so strong, population, demographics, etc., that even Lehman could not impact, but lockdown was clearly had some impact. Current year high growth is optical because of low base. Should ignore it, but for all practical reasons, in 2 years, Indian economy would have grown close to zero in real terms. A surprising development in this period has been the sharp rise in metal prices, and only time will tell what is the outcome. But this is a very counterintuitive outcome. I think some of factors what could be driving this is some supply disruptions, uh, accumulation of or bunching together of demand because certain projects are delayed or demand was accumulated. So, and I also feel strongly the last 10 years post Lehman, the investment cycle or new capacity creation in basic industries has been extremely weak, and demand has continued to grow. And also, I think the massive fiscal stimulus that various governments have carried out, and also transfer of wealth to low income factories across the world, especially in US. I think that is good for demand for goods and commodities, because when you transfer money to low income households, they spend more on goods, unlike high income households who tend to spend more on services. So this was quite a counterintuitive development of last year. I think this is the sad part of India, that India is a low income country, and the 75% of homes in India earn below 4 lakhs a year, which is 30,000 rupees a month. And and this has happened even in US. The recovery has not been a even one, because the most impacted segment of the population is those who are engaged in the urban services sector, like shop, physical retail, offline retail, restaurants, travel, tourism, spas, etc., local transport. So I think these vulnerable sections of the society, large in number, low savings, they are the most impacted. The reason why it is not impacting the economy much is because the aggregate purchasing power, especially for discretionary goods and services, is extremely small in this large body of people. And stock markets, clearly represent large companies. Most of what they sell is discretionary goods and services, and that this segment of population does not account for a large portion of the demand, at least in India. And that is why uh, I think the COVID and lockdown is more of a social problem and less of a economic problem. I think this Manish Savarwal of Team Lease put it very nicely. He said, "We are all in the same storm, but not in the same boat." Uh, I think some thoughts. I believe the economic outlook post COVID in India is better than it was pre COVID. One, because of low interest rates, surplus liquidity globally, capital flows have been very strong into India, uh, both on FDI and FII aspects. Also, the Indian government has responded extremely well to the manufacturing opportunity. There is a PLI scheme, production linked incentive scheme. First time in India, government is transferring cash to companies to produce in a time bound product specific way. I think given our large market, if we and we are also using you know tariff non-tariff barriers, so certain import items are being banned, etc. So I think we should be able to, and we have enough capabilities in this country, barring electronics. I think in chemicals, in textiles, in mechanical, I think there is reasonable capability to capitalize on this. Of course, we have to put in some extra effort to make the electronics supply chain happen. I think it will happen over time, but it will definitely take some extra effort. Uh, the What else? I think let me try and explain. Some people I have heard saying that they find the stock markets to be rational because in difficult economic conditions, markets are doing well. So I think few basic things here. One, stocks represent profits over 20-25 years. That's why you pay 20p or 30p for a 1 rupee profit. So even if profits go down, it impacts the fair value of a business maybe by 3-5%, no more. I think the bigger impact on stocks world over has been the cost of capital. Cost of capital has dropped very sharply, and thumb rule is 1% drop in cost of capital increases the fair value of a business by ballpark 10%. So I think this very low interest rates across the world, sharply lower cost of capital, I think has helped equities world over. And what has also been observed is that last year, if you see the table at the bottom, the profit growth was the best ever in last 6-7 years. Fiscal 21 profits grew by 24%. I think this was a confluence of factors. One third of the indices in India are represented by businesses that are not impacted by economic conditions in India, like pharmaceuticals, like software services exports, like metals, like refining, like utilities, like fast moving consumer goods, consumer staples. So these are businesses that where the economic linkages of profits with local conditions is extremely weak. Last year also saw the end of the weak asset quality cycle in India. We were trying to resolve these assets for last 3-4 years under a bankruptcy code, and last year was the year where the NPA problem was finally sorted. Most of the large NPAs have been resolved, provided for, or sold, and therefore the provisioning cost for banks in India has collapsed. And banks are one third of the indices, so that is what explains the very healthy profit growth last year and even current year. Banks' profits will completely normalize this year, and half normalization was seen last year. And so, even current year, I think we are expecting 30% profit growth. This is largely, I would say, driven by the normalization of profits in banks, because NPA cycle is now genuinely over. And this is what you can also see how hard it is to forecast markets and even macroeconomic conditions. And the table at the top gives you India's market cap to GDP over long periods. At the bottom, in 2000, last year, markets had fallen to 46% market cap to GDP, which was deep value. But as I said, the fear was so much that hardly anyone bought into that. And even today, you can see we are trading around 90% market cap to GDP, which is reasonable, I would say, given the low interest rate environment. So this again suggests that markets are not expensive. They are quite reasonably valued in my opinion. Uh, I think I've already covered this. Let me not spend time here. This also I've covered. Uh, this I don't think is relevant for this audience. If there is some question, maybe I think if some of you are interested, I could discuss PSUs, or maybe Sanjay, if you suggest, we could go to some questions. I think this is one sector which you should, being engineers, I think we will find it interesting. So I think power is a growing sector in India, and our power consumption per capita is a fraction of the world. As I said, just 5% homes in India have access to air conditioning, and there has been a massive shift in stock markets, at least, towards renewable energy. And most people feel that thermal power has no future in India, and therefore many thermal power companies are extremely cheap. I think this is a very top down view, and if you look in slight detail, I think you will realize why thermal power should continue to grow in India for some time. This chart at the top is the daily demand curve of India. So the power demand is not stable across 24 hours, it varies. And there are two peaks in India. One is in the morning and the one is in the evenings between 5 to 9. And at the time of evening peak and even partly at the time of morning peak, there is no solar energy available. So I think solar will not help you meet peak peak demand conditions on a daily basis. Therefore, you need thermal power more and more to meet this growing demand. And last 10 years, we have not invested in thermal power in India because of the challenges this sector faced about 12 years back. And therefore, what is happening now is that the power prices are now going up. So this is a chart, the second chart, the chart in the middle. It gives you the day ahead prices of power on exchanges, and you can see how power prices are going up. And the final point is some of the existing, see, the main cost in solar power is only the interest cost. So anyone who is able to borrow at the cheapest rate will be able to develop solar power at the cheapest rate. So the large existing utilities in India, thermal utilities, being sovereign entities, being large companies, their cost of funds is the lowest. So I think over time they will also emerge as some of the largest renewable companies in the country. And this, I think, is throwing up an opportunity, at least in my judgment, uh, because of either ESG concerns or because of the a very, I would say, superficial view of thermal power in India. Many people have moved away from this sector, and some of these companies are now trading at dividend yields which are higher than the underlying bond yields. This, I think, has created some sort of an opportunity. So let
So
me
Prashant, I mean, is India not looking at nuclear power at all?
see. Nuclear is faces some challenges in India. We don't have a proper fuel for nuclear, so we are trying to develop, but the progress has been extremely slow. We see India's peak demand is now 200,000 megawatts, and even if that grows at 6-7% a year, you need 14,000 megawatts of power a year. And nuclear power takes 5-10 years to develop, and we are developing few thousand, maybe 5 or 10,000 megawatts in the pipeline. It will take a lot of time.
Great.
So I don't think India has too many alternatives to avoid coal, at least for the foreseeable future. Till the time storage does not become cheap, and this is a slide that gives you the cost of storage. So you can see the storage cost is still pretty expensive, and till the time storage is expensive, I think moving to renewable big time is
I,
going to
rem-
be pretty
I
difficult.
remember there was a time when China was, I mean, a power plant was opening in China every week, a thermal power plant. Then US was making a lot of noise about pollution and this, but China said we needed to grow. You did it when you needed it. So,
No, even today, coal consumption in China continues to grow. And if you see the coal prices, they have hit 10-year high recently. Because again,
wow.
last 10 years, coal, new mines have not been invested in, new mines have not been opened, but demand continues to grow. Yes. So let me stop
Prashant, what
here.
is the
Yeah.
scene in hydropower? Because I also heard a lot of hydropower was getting generated along the Himalayan borders, particularly from Bhutan and India. Is it still a good bet and still a good factor for us going forward?
See, hydel power, if I recall correctly, accounts for about 10-12% of the installed power base in India. And while India has considerable potential in hydropower, it takes 10, 15, 20 years to develop large projects. There is a project called Suhansari. It is being developed in Arunachal, very large project. It got stuck in various environmental challenges, and it took only last year, I think they got the go ahead once again. So hydel is extremely capital intensive, very long gestation, because these are extremely difficult terrains. So hydel government is trying to increase the share, but it is not easy. But the good thing about hydel is that it solves. It is available on tap, so it can meet your peak power requirements extremely well. But
Got it. Yeah.
I don't think that is a solution either, because you are not able to scale up in nuclear and hydel easily.
Right, right. Okay.
So let me stop here, and I mean, any thoughts, any
Yeah.
whatever.
Yeah, Prashant, this is Puneet. I think I can say on behalf of all your batchmates that this has been brilliant. Uh, just as the clarity of thought, simplicity of thought has been brilliant. You made a passing reference when you were talking about asset classes that bonds over the long term actually don't yield, and in fact are could also be negative. I know this has been an equities focused discussion, but could you elaborate on that comment?
So, Puneet, what I meant was that in real terms, see, the question was that the returns on equities, what I presented, were they in rupee terms or real terms? So, the point what I made is that in bonds, since bonds carry less risk, uh, at least the high quality bonds, the returns, the coupon that you earn are very close to the inflation. And even today, if you look at India, the yield on a 10-year bond is 6%. If you give money in a bank, you will earn 5%. But that is equal to inflation. If you go back 20 years, 30 years, bank deposits used to be 10-12%, but so was inflation, as you can see here. If you see in 80s and 90s, the inflation was 9-10%, and bank deposit rates were also about that. Now bank deposit rates are 5-6%, inflation is 6%. So fixed income, it preserves your purchasing power. It does not increase it. So that's what I
Good, good. Understood. Thanks.
Hey Prashant, Shish Sindhu here. I had a quick question about retail investor behavior. So, what it seems like is that the retail investors got much more spooked in 2008 than in 2020 in the pandemic, because people pulled out money and stayed out of the market longer back then. And this time, I think participation may be increased during the pandemic year. So, any explanation of this psychology of investors, retail investors?
See, equities are very funny. In most aspects of life, you go to experts, but in equities, I don't really know, but almost everyone seems to have an opinion, and they are pretty confident about it. So I think what happens is whatever, and they are simply saving returns. Simply, so whatever sector has a good premise, so where the intellectually you can justify how a sector can become very big, and as prices start moving, more and more people join, and it becomes a self-fulfilling prophecy. Gives you more confidence. You invest 1 rupee, 5 rupee, 100 rupees, and so on. And in the end, I think 9 out of 10 people end up losing money over the cycle, because the investments what they made early on in the cycle was a fraction of what they invest in the last stages of that particular theme. 2007 8 2000 2007 8 both were massive losses, and in 2000 IT sector used to account for almost half of the index weights. So you can well imagine what was happening. And in 2007 that got replaced by power sector and by real estate. And what also happens at the same time, when there is an excess in one area, the other sectors tend to become extremely cheap. Now, coming to your question, what happened last year? I think people sold when the markets were down very sharply, because there was so much panic, and it was very intuitively appealing that if everything is shut, businesses will make losses, and the world will come to an end, and no one knows what will happen. So significant selling was there in the first 1-2 months. But then what happened, uh, when 100 rupee stock becomes 50, or 100 rupee NAV becomes 50, you are in a state of shock. And because most people have not experienced these cycles before. India is such a young country. Every 10 years, the market is dominated, in my opinion, by people who have no experience of the previous cycles.
Very interesting. Yeah.
So you are shocked and you just, but you did not want to book that loss, so you stayed put. And as markets came up, we saw huge redemptions in mutual funds. That was basically 100 rupees NAVs being restored, and you saying, "Oh my God, my money is back, let me move out now." Now, what has happened simultaneously is three things. One, people were at home, and the upper middle class, the higher income groups, they have more savings because expenses have been low. Interest rates have collapsed, and there has been a forced adoption of digital. And whatever you bought last year has made huge amount of money. So it has given you confidence. Money is there, confidence, ease is there, and low interest rates. So I think that theme is now playing out, and we have seen, as I said, almost a threefold increase in the number of demat accounts in the country. So I think, and these things can go on. It does not mean that it is going to end tomorrow. So I think this could go on, but clearly I am beginning to see, excess supply, a lot of supply of new stocks coming up, and certain sectors are clearly experiencing rapid rise in prices, which is a clear sign that excesses are now building up. Yes.
So Prashant, how long will this liquidity gush
Thank you.
last? Means it's a question everybody wants to answer, but what's your take?
So I don't think anyone has an answer to that. See, few things are worth noticing. Noting that most central banks have become far more tolerant of inflation. See, the character of central banks has changed. Until I would say some time back, their main mandate used to be to preserve price and currency stability. But now they have come to believe, rightly or wrongly, that their main mandate is to support economic growth. And they continue to print money, keep interest rates low, and they are saying that earlier people would act in anticipation of inflation. Now they are saying this high inflation will pass, and we need to be sure that inflationary forces are strong before we act. So I guess at some point interest rates will move up, especially in the US, because you can't have 10-year yields at 1.5%. And but they remain low for how long, I don't think anyone can say for sure. That is the biggest risk to equities. The good news is that interest rates will not go from 1.5 to 3% overnight. It will take time, and therefore I think one should be observant. Coming to India, see, there are two things which in my mind make India better placed. Number one, while interest rates are low in India, they are not as low on a relative basis as they are in US lowest ever interest rates. India 10-year yield at 6% is not the lowest ever. In 2005, 10-year yields were at 5%. So maybe the yields go up 1%. That is okay. The second issue in India is, see, you are growing, the fair value of businesses is growing at 12-14% a year. So what that means is, even if rates go up by 1%, let's say, it reduces the fair value by 10%. But the fair value also increases by 10-15% that year. So I think in a growing environment, the maybe it will lead to flat returns, no returns for 1 year or 2 years. But I think the longer term case of equities will not be disturbed in India. See what Mr. Buffett says, and I also agree with that. He says, look, forecasting macroeconomics is extremely difficult. And we have seen it time and again. I have seen it time and again. So he says, you just focus on the value of the business, the quality of the business, and the value of the business. And don't worry about the macroeconomics. And you can see it in the performance of Sensex or Dow. Over 40 years, 100 has become 50,000. There was a time in this period when US interest rates were in double digits. US 10-year yield, I think in 80s was 12-14%. I have myself seen Indian 10-year yield at 12-14%. And we have, so I think economies continue to grow. You have to make sure that you don't overpay for equities and hopefully keep some margin of safety. So don't build in this very low cost of capital when you are arriving at the fair value of a business. Yes.
I'm not sure what's going on.
Sandeep, this is your special technology.
That's not true. Someone is doing something. I'll just mute everyone else. Yes. It's not any special technology or anything.
Okay, I mean, I just wanted to check if people are interested in hearing Prashant's views on the budget or anything like that.
Yeah, I wanted to know the IPOs which are coming up of loss-making companies in India. So, what is your view on these new age companies doing an IPO?
I think Sandeep, I think it's a mixed bag, and clearly some of these companies have a good business model. Let's say you look at these food delivery companies.
Yeah.
I think the business case is a sound one, because what you have managed to do is to aggregate demand, and you have created a virtuous cycle which gives you pricing power at both the ends. You could charge higher take rates, and you could also charge delivery charges. And it's a oligopolistic business. In fact, if you look at regionally, the regional market shares are even higher in India. So I think that's a good business. And as I mean, we know in US, many homes don't have kitchen. People don't cook at home. So if you think really long, I mean, this could become more, center stage kind of a business. So I think the business case is good. Now the difficulty is these businesses are so valued, so highly valued. It makes it very, and the variables, if you think 10 years out, can be all over the place. I mean, whether 5 crore Indians will be customers of these food delivery companies, or it will be 30 crores. Whether the average order value will be 400 rupees or it will be 1,000 rupees. Whether people will order 4 times a month or 10 times a month or 20 times a month. So we are dealing with a very, very wide range of variables, because these are not mature businesses. And unlike IT, where you knew how large the market was and your growth rate was a function of at what pace you gain share, here you are creating a new business. So I think it is hard to take a definite view. So these are good businesses, very expensive, and I think in a portfolio it might make some sense, but I would not itself is whatever they do, the banks can do it equally well. I mean, the banks face a little more regulation, but there is very little stickiness or moats, entry barriers that these businesses are building. So I would be a lot more worried about these businesses. But we have seen in first mover situations, if you add value to the customer, if you manage to get sticky customers, you will create economic value. Your returns, of course, will be a function of how much you pay, and which is not easy to assess in these cases. Yes.
Prashant, this is Naveen Gupta. Hey, brilliant talk, absolute clarity of thoughts. I have a question on this pandemic versus China thing. Because of the pandemic, there is a huge anti-China feeling all over the world, right? US and the Western countries have thrown their lot with India and against China, right? What is the reason? So all these countries are taking their production out of China, right? Finding other options. Why has India not become the natural choice? What are the challenges to it? And how do you think the government is rising up to the occasion? Why is 2021 not becoming a game changer for Indian economy because of this anti-China feeling and the feeling in the US that, hey, we cannot depend on China. We need to build some options. So why is it not becoming a game changer for Indian economy?
No, it will. I think it will have a significant impact, and the reasons are both economic and non-economic ones. So, economic reasons are cost of production in China is now going up. Their wages are 4 or 5 times of India. Their compliance with environmental norms is improving, and government is encouraging less pollution. So, I think clearly the shift is taking place. But see, we should not underestimate uh, the scale, the sophistication that China offers, and it is not that has been built over 20 years. So you can't replicate that in 1 year. And in some areas like electronics, India has nothing to offer. We have no expertise, we have no supply chain, absolutely nothing. And you know what is happening now? Even semiconductors are in such short supply, so you are experiencing supply disruptions in a number of products because the global supply chains are extremely complex, and there is huge amount of cross dependence across countries. So I think it will happen, but it cannot and will not happen overnight. But clearly we are seeing that there is a strong desire amongst the global companies who source from China to develop at least one incremental source. And as you perform, as you supply 2%, next year they will move give you 4, 5, 10%. That is how supplies shift. But I don't think we can write off China in the near term, and it is not going to happen. The shift should be steady and gradual, but as I said, what would have taken 10 years earlier maybe will now get compressed to few years. But China will continue to be extremely strong in manufacturing. They are moving up the technology curve rapidly, and you are seeing it in a number of areas where it is not just anymore a very low cost producer. They are also becoming efficient or good producer. Yes.
Yeah, but Prashant, can you
Got it.
hide, stop the sharing and switch on your camera?
Sure.
तो प्रशांत नगेंद्र हियर। तो ये बताओ कि ये स्पैक डील में आजकल बहुत वर्ड सुनता हूँ, ये क्या लफड़ा है?
See, this is I think, product of extremely. See, money has lost value, and so there is so much money available around the interest rates. So I think it's basically, I forget the full form, but basically you are giving money to a entity which will go and buy some other business. That's it.
Right, special purpose acquisition company.
Acquisition, yes. So I think it is a sign of. I think it is irrational to my mind, and there is an excess in certain pockets of capital markets, and I think, someone may do a good job of it also, but I think that appears to be the case.
So nothing special about it, huh?
I don't think so. Okay. See, most innovations in capital markets are, you have to be careful. Because the building blocks are basically two, equities and bonds, and everything else is, you are adding some complexity, something, but I don't think it adds value to my mind.
So one very important career lesson that I learned was that you need to be late on the train and pick up the last compartment. So, what is the last compartment these days?
I didn't follow.
नहीं तो तूने जो है सबसे लास्ट ज्वाइन किया था ना?
अच्छा ओके आप लोग यूएस में बैठे हो, आप लोग ने अच्छा किया ना हमसे, हम तो क्या है लो इनकम कंट्री में बैठे।
नहीं यार, लास्ट कंपार्टमेंट तो पकड़ना जरूरी है।
So, I mean, related to that, Prashant, I mean, a bunch of people reached out to me. यार ऐसा कैसे कर दिया तुमने कि we can't ask questions. जिससे हम सब सोच रहे रिटायरमेंट का कि अब इंडिया जाके रहेंगे, but we don't know where to park our money or what's the best way. We should be able to ask these questions. मैंने कहा पूछ लो भाई. So I'm asking you on everyone's behalf. Like many NRIs are in a position where they can easily go and retire in India, but they have no clue what to do with their money.
I totally agree with Vishwa. So we all are at a stage of our career where we have accumulated some wealth, right? And we need to park it. If our friend is #1 money manager in India, how can you help, Prashant?
No, see, I think definitely I can help. And see, there are few things you need to keep in mind here. See, the key is asset allocation, and I mean, let me share what have I done in investing, and I think then you will understand this issue even more. That I am not evading this issue. See, I have never owned even a single stock ever, and I put all my money in my own fund. Now, there are two reasons for that. Law allows us in India to buy stocks, and many of my peers in the industry, they buy stocks also. So there are certain checks and balances, clearances you need, but it can be done, and some people do it. But I have not done it, and I will tell you why. Because see, the moment you invest in stocks, you have to build a diversified portfolio, because that is the first rule of investing. See, for 10 to become 100, it will take you 10-15 years. For 100 to become 10 or 20, it can happen in 6 months if you buy some wrong stuff. So the way to reduce that risk is to remain diversified, to focus on quality, and to not overpay for businesses. And I showed you that chart on Sensex. Now, there is no security involved there. And there are many mutual funds in the country who have done even better than the Sensex over long periods. There are funds whose NAVs are now in 900 and 1000, and the starting NAV of everything is 10. So I think you must decide to allocate money to equities, to bonds, to real estate and gold. These are 4 broad asset classes. And gold, I think, is insurance. It is less of an investment to my mind. It has more characteristics of an insurance, because gold has some very unique characteristics. It will hold on to value when the whole world collapses around you. If your country becomes like Afghanistan or some other country like that, even then it will hold on to its value. So you hope that never happens. You don't need the insurance, but I think some money we should park in gold, 5-10% of our wealth. I don't think personally this is a good time to buy gold, because interest rates are so low globally that gold is done quite well. Because what do you do if fixed income rates are 1.5%? A lot of money flows into gold. So I feel, I could be wrong, that if US yields were to go up in next couple of years, it would not be good for gold, and that might be a good time to pick on gold. But then you can always buy some gold because it is an insurance. Fixed income is that portion of your wealth on which you emotionally or financially don't want volatility. See, some people move money out of bonds just because interest rates are low. I don't think there is some merit in this, but it is not you should not think like that. Because let's say interest rates are extremely low and you put a lot of money in equities and markets don't do well, then you are in deep trouble. So I think you should figure out what is your emotional and financial tolerance for volatility, and that much money is your risk capital, and that you should invest in fixed income. Rest you should invest, that you should invest in equities, your risk capital, and whatever is your safe capital, where you don't want emotionally or financially risk taking, you should put it in fixed income irrespective of the returns. Now, when it comes to equities, I would sincerely urge you not to buy stocks unless you know you have some specific idea about a particular industry company, that is separate. But by and large, I think it is better not to do it directly. You have two options. You can buy either the passive funds or the active funds. Passive funds are extremely cheap in India, maybe 10-20 basis points. So you could just grow your wealth 10-12% a year, a long time. And the good news, added advantage of equities in India is the tax efficiency. On whatever you earn on fixed income, you pay full tax. I don't know what are the tax rates applicable for NRIs, but at least for resident Indians. And on fixed income, on equities, you pay capital gains, which you pay when you book, and they are quite low. So I would say divide your wealth in three parts: insurance 5%, 10%. On a really bad day, the whole world collapses around us. Gold will help. Save capital, put it in interest bearing instruments. I would suggest don't buy long bonds at this stage because interest rates are extremely low. And if and when, as and when interest rates move up, you could actually make losses on long duration bonds. So keep short duration bonds in the fixed income portfolio, and you could buy equities, either active or a passive, whatever. I don't think there is much difference. The good active funds beat indices by a few percentage points a year. Some may not. So net, it may not make much difference, and it keeps life extremely simple. Yes.
So, Prashant, what's your opinion on investment in real estate in India?
See, Pankaj, the real estate is not a homogeneous asset class. And I will give you a good, simple example. I've been in Mumbai for now 30 years. If you bought real estate at Nariman Point, which was the commercial hub, like the Manhattan in New York, Nariman Point was that equivalent in India. If you bought real estate then, over 30 years, you have not made money. You have actually lost money because it was so expensive. And city has spread out now. Alternate business districts have come up. But if you bought real estate 10 kilometers away, or 20 or 30 kilometers away, it has done phenomenally well. So I think point number one, real estate is not a homogeneous sector. It the location, the development makes the how a city evolves makes a big difference. Generally, it has been observed that real estate gives you real returns. A diversified portfolio of real estate gives you real returns comparable to equities, maybe slightly lower, but the returns are meaningful, real returns. The challenge is diversification in real estate becomes extremely difficult. And I personally don't want to buy real estate because it is quite cumbersome to buy, to rent it out, maintain, to transact, and stuff like that. I think you could consider REITs in India. Now we have two or three real estate investment REITs in India. One is by Brookfield, which is the Canadian institution. They have a real estate REIT in India. The other one is Embassy. So I think, and they distribute 90% of by Indian law, whatever they earn, they distribute, and the expenses are quite low. So I think you could consider buying the REITs. It would be better to my mind than buying physical real estate. Of course, you know what has happened in India. Let's say you have a state which is, or a part of a country which is less developed, and land could be very, very cheap because the return on land of agriculture is 1%. So in some places land can be extremely, extremely cheap. And in some cases, if that state or district develops or it becomes a capital or some infrastructure project comes, large project, then that land could appreciate very sharply. But I don't think currently we have a situation like that, because to my mind, barring maybe some remote corners of the country, land prices in India have done exceedingly well over last I would say 10-15 years. So I would, but if at all you have some specific knowledge, interest in a particular area, you could do that. As far as the rental yields are concerned in India, on residential real estate, rental yields in India would be about 2.5% across metros. The mortgage rates are around 7%. In the West, the rental yields are more than the mortgage rates. That is not the case in India yet. And the rental yields in residential are roughly one third of mortgage rates. In commercial, the rental yields would be near mortgage rates, around 7-8%. Yes. The impact of work from home, uh, I don't think is fully understood, but I feel it should not have much impact on the commercial real estate prices, because if work from home, see, one India is a growing economy, and work from home, if it impacts rentals, it will also impact supply sharply, and therefore I think over time rental yields should hold up and maybe even move higher on the commercial side. Yes.
Uh,
So I have one other question. The basics. I mean, never understood finance that. So what happens when a bank actually fails? I mean, people who have their accounts, they get back only part of the money, or what really happens?
So, I mean, theoretically, technically, you are right. When a bank fails, the depositor is unlikely to get much money back. Uh,
But if you are invested in bonds, yeah, I mean, that's much safer. Is that right?
See, yes, I mean, if you invest in high quality bonds, but in Indian context, I think the failure of banks has been extremely limited, and what has failed once or twice are extremely very small privately owned banks. So I think the banking sector is fairly well regulated in India. It is well capitalized, and post Lehman, the capital adequacy norms of banks across the world have gone up. In India, we also have CRR and SLR, cash reserve ratio and statutory liquidity ratio. So almost a quarter of the balance sheet of banks is in government securities or is in cash with the RPI. So I think banks in India are quite safe, and I would suggest that whatever we are investing in fixed income, we should not take risk. See, it does not pay to take risk in fixed income. It is, I don't think, makes sense to chase yield in fixed income, because the incremental returns are very low and the risk can be very high. So I think
Just keeping money in the bank is safe enough?
yes, I think if you go to a large bank, it is extremely safe. Any of the large banks, public banks, or any public bank or large private banks, I think money is extremely safe.
Wow.
Or you could also buy government securities if you want. I mean, you can also buy government security funds, or you could even buy a government security directly in your account. It will give you 6% for 10 years, but of course it is taxable. But you can do that. It is like buying a stock. It is all in dematerialized form. So you can buy government securities or even company bonds. You can buy directly.
Wow. Okay, thank you. Anybody else has any questions?
Yes, yes. So hello, so this is Asmuk here. So of course, I have seen much less and in 40 years what you described. a specific question about money psychology. So basically, what have I seen in last 20 years as a human nature, we want to book profit fast, and then we can remain in loss for very very long, considering that probably you are getting it cheaper. Like Suzlon was a classic case where over the years people thought that it is getting cheaper, so let's buy it, and they were in long losses for very very long time. But generally, in a profit scenario, you would would like to take the profit away. So I just wanted to understand how could we, from a psychology perspective or psychology, we can use that mind, or we can be less psychologically impacted, or how could we balance it, right? To really, like I could see from last 20 years, I could have made much better return than using this psychology has actually hampered quite a lot.
Yeah, Hasmukh,
No, I
video
think,
to lagao.
no, I think, see,
Can't you see me? Yeah.
See, I think this is a very, interesting question, but I don't think I can do complete justice to this in 5-10 minutes. But let me try and share with you some thoughts. See, one, I think the profit and loss, this is actually quite irrelevant in a investing situation, and let me explain why. See, if you buy let's say the price of a security today is 100 rupees. There are two situations. You may have bought it at 50 rupees, or you may have bought it at 200 rupees. In one case, you are down 50% and you are very upset. Your 200 has become 100. And in one case, you are happy. Your 50 has become 100 and you are happy. But the reality is you have only 100 rupees. And just because no one other than you knows your cost of acquisition, and no one is interested, and the stock market will not move in future depending on what your cost of acquisition was. So the way to look at this is the price today of 100 rupees is your. If you think that way, then you will think rationally. Because if you bought at 200 and it is 100, but it is going lower, you are better off selling it today. If you bought at 50 and it is 100 and it is going higher, you should even today not sell it. So I think the key is not your cost of acquisition, but as I said right in the beginning, EQ is more important than IQ. So I think in our minds we carry two accounts. One is booked profits and loss, and one is unbooked profits and loss. And we feel good if we realize again. It moves from the unbooked to the booked compartment. And no matter, what will you do with that 100 rupees? You will go and buy something else. So your risk remains still the 100 rupees. But you just feel good, I have made an accounting profit. And you will pay tax on that also. But if 200 becomes 100, you hang in there because your mind recalls that cost of acquisition. And you feel very upset to book that loss because it makes it permanent in a way. But it is wrong to think that way, because if the key is cost of acquisition actually should not matter in this business. What you should focus on today's value, because that is what you will get when you sell. If it is a good investment at that price, hold on. If it is not, you sell. And see, Suzlon, what you mentioned, I can discuss this because see, this business is not about buying stocks. It is about understanding businesses. So that was a challenge business because it depends on the supply chain of what is a windmill. You are buying gears from someone. So it was a fairly, it was a nascent business like today people feel in solar power. So I think they got very ambitious. They bought companies in Germany here and there, and over time the demand did not keep pace. And see, entry barriers are not there to that business because you buy blades from, the generator from someone and gears from someone, and you could assemble a windmill. And the sites became less. The sites which have ample wind power, they slowly, because you will put up windmills initially at the most windy sites, then I think that business ran into challenges, and that again comes back unless you understand a business well enough Don't buy it because competition changes, new players come, technology changes, and many of us overpaid. I mentioned to you some time back. This must have happened around 2007-8 because power was a very hot sector then. So, and of course, that business has gone into near bankruptcy, stuff like that. The second thing to keep in mind is never buy one stock, buy 20 stocks. And that is why I hesitate in sharing stocks, because it is very difficult to share 20 stocks and across sectors, across variables. But that is the cardinal principle of investing, that build portfolios that are diversified. See, the three rules you must keep in mind when you are buying stocks. First rule is, will the business survive for 10 years? Do you understand the business enough? It has some comparative advantages that it will at least survive for 10 years. That is the first question to be asked. Second, you can ask is, do you have some view on the growth? Can it see disruptions due to technology, new players, etc.? And the third is, what are you paying for it? That is most important. And I will give you an example here. If you see, software sector in India has never degrown, never, not even 1 year. So, but if you bought in 2000, it was really expensive. If you bought it then, the business has grown every single year, but you made no money for many, many, many years because you paid a wrong price for it. So I think there is a very good correlation between value and your returns. So, as I think Warren Buffett, someone has said, price is what you pay and value is what you get. So, unless you understand the business, unless you know how to value it, I think you should not participate. Even if you buy, at least buy 15, 20 stocks. So, over time, there is a higher chance of at least getting the index kind of returns. Yes.
Thank you very much. It was good insight.
Yes.
Hey, Prashant, one more question from Ashish here.
Yes.
So one thing that I sometimes worry about as I think about the future of the Indian economy is that the growth is very varied across the country, right? So there's that north-south kind of divide, like some of the states like UP or Bihar, and some of the northeastern states, etc., are falling behind more and more compared to some of the more industrialized states and so on. So is that disparity going to impact our future growth potential, or someone like you doesn't worry too much about it because you think it's going to work out?
See, I think it is more relevant from a social point of view and less from an economic one. Because, I think this disparity across geographies would be there even in countries like US. I mean, I'm just saying, I really don't know, but I'm sure the per capita incomes vary significantly across states. And the same is true for India. I think it is leading to a lot of migration within the country. If you go to South India today, in Chennai or in Coimbatore, you can talk to the waiters in Hindi because many of them are from North India. The construction workers in South India now are from North India, Orissa. If you look at the airline staff, large part of it is from Northeast. In many restaurants, the waiters or the waitresses are from Northeast. So I think there is a lot of migration taking place within the country in search of living, and that is because of these disparities in growth rates. Interestingly, India now has one GST, unified tax across the country, single tax, goods and services tax. So India is now one large market, and there are no barriers within the country. So I think as far as investing is concerned, companies are sell throughout the country. Supply chain in India is evolving very rapidly. highways are pretty good. Dedicated freight corridors are becoming a reality. So India will now have 2 or 3 routes only for goods trains. So the average speed of a goods train in India is 24 kilometers. It will now go to maybe 60, 80, 100 kilometers an hour. So logistics costs are dropping. So I think over time these disparities may remain, because it is very hard for a new area, underdeveloped area, to attract investment. I mean, Bihar or Eastern UP, they are good examples. So I don't know how that problem will get solved, but I don't think it comes in the way of economic progress for the country as a whole or for the stocks. But there are villages now which have very few young people left, mostly elders or women. So if you look at Mumbai, where I stay, most of the drivers in this city or plumbers are from UP and Bihar, and most of them have left their families behind. So I think, uh, though some states, there are some interesting developments. Though there is now competition between states, and this government is encouraging that. So ease of doing business rankings are now published state-wise. So there is competition within the states to come up, and so there are some surprises once in a while. Telangana, for example, has done exceedingly well in attracting new investments. So I think there is competition across states. Over time, this disparity may reduce, but it could lead to some social changes. But I don't think it really impacts the economic future of the country. And one interesting development, very interesting, is this work from home. See, if you look at the development of software industry, it was concentrated in Bangalore, Hyderabad, Chennai, and Pune, and to some extent Noida. And many companies in India now they say maybe between 25 to 50% work from home should be allowed. Workforce could work from home. So you could employ people, men, women, sitting in Bhubaneswar or Cuttack or wherever, and you work from home. Have a small localized office where you could go once in a while. It could lower wages, give you flexible working hours. So I think this is something that needs to be watched, at least for some industries, and it could create jobs in otherwise less developed areas. Yes.
Got it. Thank you. Thank you.
Prashant, what are your thoughts on the informal sector? We keep hearing stories that the formal sector, the Sensex wala sector is doing well, but that formal sector is actually cutting jobs, and or if not cutting jobs, but not really increasing in a big way. Whereas the informal sector is growing. All the thela walas, the small shopkeepers, the guys who are the ones who are employing people, though at a small wage or whatever. So is there something that some say that informal sector is what will lead India's growth? So don't count too much on India Inc. I'm just asking that question because I just heard a presentation from Captain Raman. You might have also seen that video where he's talking of India Uninc leading the growth. So just wanted to take your thoughts on that.
See, I think these are very, complex issues, and I think the truth is somewhere in between. And I don't think it is a either or kind of a situation. And see, I think the e-commerce, they work from not work from home. These food delivery kind of companies. I think they are going to put significant pressure online retail on lot of these small businesses. And I don't think the next generation in many of these businesses will choose that as a occupation, and I think they will do different things. So I think, as I said earlier, this COVID lockdown has been a greater social problem than an economic one. and that is why there is so much of migration across the country. I think uh, there are potentially challenges which the lower income could face in urban areas, in the service sector, in small mom and pop shops, because definitely in 1 year of COVID, lot of habits have changed, and people are now ordering right from fruits, vegetables, clothes, and shampoos and washing machines online. So India has crores and crores of small shops. Their livelihoods are going to be impacted, and how much of change is for good once we completely open up, times will tell. But I think the good news is that the white collar and the blue collar wages in India have converged. And let me give you an interesting insight. The real challenge in wages in India has been in white collar wages. If you were a software programmer in 2003, your starting salary at a leading software company was around 3 lakhs per year, 30,000 rupees, 25,000 rupees a month in 2000, 1 to 3. That time, a blue collared worker in Mumbai was getting 4,000 rupees a month, so 50,000 rupees a year. So the software programmer was getting 6 times that of the blue collared worker in Mumbai. If you look at the situation today, the software salary, starting software salary is still 3.5 lakhs, maybe 4 lakhs. After 16 years, the programmer's starting salary has not changed. Of course, the skill levels have gone down. The what you are hiring today at the entry level is in much larger numbers from weaker schools, but still it's a white collar job, and that salary is same as that of a blue collar person in Mumbai. So a driver or a
Yes,
plumber
yes,
in Mumbai will cost you the same. So there has
that's
been a
true.
70-80% deflation in white collar wages in India, and blue collar wages have actually done quite well. I think what is happening is because of a false sense of dignity of labor is missing in India, and a false sense of dignity. No one wants to become a plumber or electrician. Everyone wants to become work in a office, no matter how much that job pays you. So I think that is why I feel that if push comes to a shove, there is enough opportunity for someone who is willing to adopt one of these occupations to more living than what even a white collar at the lower ends would get. So, and I think that way this
Hmm.
situation should resolve itself out over time. And also the
Right, right.
minimum wage levels, the government keeps on pushing them up once in a while. But for someone who is in the older generation, running a shop, unable to learn a new trick, for those sections, incomes could see some impact.
Uh, Hello, sir. I had one more question. We are talking about science sex and many other things. But from what your view, what from last 40, 50 years, MSME exchanges are not been able to develop, or we know about it. See, currently, let's say there are still VC funds, but they are also chasing only few Bangalore and Gurgaon companies. But India is huge, right? So we have seen, at least I have seen, small exchanges. They would, if they don't have collateral, they just can't get loan also from the bank. But there are smaller exchanges from Indore or Pune or wherever it is. No, they never could develop in India. It's actually larger part of India is still in same problem of accessing fund.
See, I think that has changed. I mean, what you are saying is right, but there is a reason for that. Though things are changing for the better. See, one, the non-performing loans in SME segment have been very high in India, very high. Because many SMEs in India have not invested in technology. They have not been able to scale up, and they were surviving basically because either they were not paying for their power, or they were violating labor laws, or they were not paying taxes. And of course, the larger companies were also not paying them on time. So I think the truth is somewhere in between, But government is quite focused on that, and very recently in the COVID, to deal with the COVID situation, government has come out, I think, with 2 times with the, what is it called, ECLG scheme, where the government has guaranteed credit of, I think, 1 or 1.5 lakh crores to SMEs. So if a bank has given additional credit to a SME in this period, it is the first loss is with the central government. So nothing, I mean, this is the first time, and I think this was a specific response to the current situation. But you are right. See, the SME sector in India is not very well developed, like it is in Germany, and I don't know how things will evolve. But you are right. The stock market does not see much activity in that spaces.
But would you see something happening in future, at least for MSME exchange? Like if I want to raise 1 crore kind of a rupee, I cannot list in a Sensex or NSE, right?
No, I think there is a dedicated exchange for that, and I can connect you. There is an exchange where I have seen some few companies are listed. What is it called? I forget. But some companies have also moved from that exchange to the main exchange. I think there is an exchange like that.
But the liquidity would still be very less, right? Nobody would be buying those stocks, right?
That's okay, but you can raise money. There are people who are willing to put money behind interesting ideas. See, capital is not a constraint in India anymore, world over. So, I mean, if you have a powerful idea, and if I don't think money is a constraint at all.
Okay, I think we have come to almost 2 hour mark. I think we should thank Prashant. Ravi or Rajiv, you guys have been quiet. Anybody who wants to ask one last question, and then we can wrap up?
Yeah, Ravi should ask. He has been smiling all over.
Yeah, I know. He's always quiet.
He is busy taking walks behind his house.
Ravi, where are you? You should ask one question. I don't think his.
You're on mute.
His audio is not working.
Yeah, his audio is not working. All he can do is smile and give his support to Prashant.
आशीर्वाद दे सकते हैं.
You can write your question on the chat.
I enjoyed the talk. I had to be in and out because कुछ लोग काम करने आए थे यहाँ पे. We had some delivery coming, so I missed some of it, but I got most of it, and it was a lot of fun. So awesome to hear, see what you're doing.
Prashant, outstanding talk. कभी US आना होता है क्या? तो we'll meet here.
No,
we are in LA.
No, sure. Some point of time I will come.
So
Yeah,
you have made a lot of money, so now you should visit the world and meet all of us. Right?
Yeah, of course.
अब खर्च करने का समय आ गया.
No, but for meeting you, we don't need money, right? All I need to pay for
Naveen only meets people who has money. So
no. That was to.
I thought I only have to pay for the ticket, and then you will take care of the rest.
I mean, that's good.
मैं उसको बोल रहा हूँ आऊँगा तो बोला नहीं अभी बताओ.
पहले कमा लो.
यार मैंने सुना कि शिट ने एक पूरा वर्ल्ड टूर बनाया था to do some research on something he was doing. So it was a business come personal meeting.
He visited me also in that tour.
Yeah, he visited a lot of us.
प्रशांत ने उसका एक्सपेंस रिपोर्ट अप्रूव किया था.
ऐसा एक फंड बनाते हैं IIT के 89 मस्ती फंड. उसमें सब लोग थोड़ा जमा करते हैं, फिर हर साल कुछ करते रहेंगे.
और क्या? And we have money manager who can manage this fund for us, right?
Yeah, I think you should invest in equities. See, US equities, I don't understand, but at least in India, I think over time, I don't think you should be disappointed. And the currency also should remain reasonably stable, I feel, longer term. Because as the world moves to EVs, it will be very important for India because India imports crude oil worth, I think, 100 billion US a year. It's a
Wow.
single largest import. So as you, in 10 years or 15 years, as you shift away from oil to energy, electricity, which is solar in India, 20 years down the line, it should be run by solar because we have huge solar energy. So I think it will lead to a fundamental shift in the current account deficit. It will collapse. And of course, if we do well in manufacturing, even if we make for just ourselves, forget export, it will be very good for the country.
I think bigger question is, Prashant, how do we give our money to you for managing for us?
No, I think you can invest for the time being. I think you should invest in any, you can invest simply in a index fund. I mean, trust me, and just leave it there. See the good, I'll tell you the good part of this environment, good and bad both. If you don't earn anything for 3 years, what will happen? Your opportunity cost in US is hardly 3-4% over 3 years. So never before have we seen such low opportunity cost of investing in equities. And I think of Indian equities should definitely outperform US bonds at least, because the gap is just too large. So I think you should invest some money in Indian equities, and you could buy any index funds. It will be a good place to start.
So Prashant, I have actually two questions. One is related to the discussion right now. NFTY is a ETF. I think it's an iShares ETF traded on the US stock exchange for those of us who are in the US. And then there's also INDA, which is another India focused fund. Are they good funds? Like, in your opinion, do they have sort of good breadth? And second is, like, if there's a better vehicle for folks in US who don't have an account necessarily in India for these things.
See, I'll ask Sanjay to give you my email and drop me an email, because I'm not familiar what is trading in US, but the Nifty ETF is a replica from what it sounds. It should be a replica of the Nifty index. So I think that should be a good vehicle. You should just check the expense ratios. Normally, ETFs and index funds have expense ratios which are extremely low, very, very low.
Okay.
But if you drop me a mail, I'm sure I can find out and revert to you.
Sounds good.
So you're going to share your email address with us, right?
Yeah, I'll send it to Sanjay, or I'll post it on the group.
Okay, and you are going to share your presentation as well, right?
Yeah, this
that was
is
a terrific presentation.
Sure.
Cool. Hey, outstanding presentation here. On behalf of the whole batch, I think we learned a lot. But I think there is still some question coming from somebody.
Yeah, I wanted to ask you about EVs. What you said, I think I feel personally the same way, because I'm working in the automotive market, especially on the autonomous vehicle side here in the US, and EVs are the big thing right now. But I don't see a lot of companies investing, or like Indian companies doing stuff. Maybe EVs, not so much on the autonomous vehicle side, but not really that much, right? It's still the old powertrain. I know that US companies are starting, but I mean, there's Mahindra, there's, I think, Tata, those are the big ones, I think, in India. I don't know if they have any meaningful investments in those areas. Or maybe.
I think EVs, India should do reasonably well, because the government is very focused, and they will come out with a PLI scheme very shortly for a large battery plant.
Okay.
And I think EVs, there are quite a few companies in India. And I mean, Tata has a Nexon is there. It's a very successful EV, very successful. And in two-wheelers, I think we will move rapidly towards electric vehicles in the next 1 to 2 years. I think the price parity has been reached in two-wheelers and in three-wheelers. There is a lot of emphasis on shifting public transport, like city buses and fleet taxis, to EVs. There is intense focus. There are two levels of subsidies: central government subsidies and every state is also offering additional subsidies. So I think India should do reasonably well. I mean, I've been thinking, will hydrogen? I mean, hydrogen appears to be a superior alternative even to EVs. So, is it worth investing for something maybe which will over time get passed over by hydrogen? But anyway, I think EVs we should do quite well, and therefore, see, this is one of the risks to investing. Now, still, if you see the ICE company, the car companies, the component companies, they are trading at fairly rich valuations. But when this shift will take place, and it's hard to, most people don't understand. So I think understanding a business, the risks, the competitive advantages is what is really most important in this business.
Okay, perfect. I think we should stop at this point. I mean, it's been a long time. Hey, thank you so much, Prashant.
Yeah, thank you all the
Thanks,
best.
Prashant.
Yeah.
Then
Thank you.
one thing, if I say, Prashant, like you should definitely write a book someday because you have such a simple and intuitive way to explain, and a lot of the lay people can benefit besides the IT 85 only.
Fine,
Hey,
sure.
Prashant, we'll see you in the next reunion, right?
Yes, definitely.
Cool.
Awesome.
Okay.
Awesome. We're still deciding where it'll be. There are a few ideas, but I mean, nothing is finalized.
I think Rohit Verma has.
Yeah, he's been quiet. Yeah, because of COVID. But the other idea was that people might need it in Africa actually for safari. So even that'll be interesting.
Yes, madam.
Okay, perfect. Hey,
Thank
thanks
you.
once again.
Thank you. Bye. Bye.
Take care. Yeah. Bye.
Thanks,
Bye.
Mr. Thanks.
Yeah. Bye.
And there's internet over there. If I plug in my laptop directly to the router, but there's still no internet going through the network.
Hi, Naveen. Hello. Naveen, I'll remove you. Sitaram. Hasmukh. GK.